Are you a day trader or an investor? Many day traders think they are investors, and many confuse trading with investing. After watching this video, you will know if you are a trader or an investor. What's the difference between a day trader and an investor? Before going deep into this topic, we should first know who they are. Firstly, an investor is any individual, entity or organization, such as a firm or mutual funds, so on, who commits capital with the expectation of receiving financial returns from any assets class. A day trader is a type of trader who executes a relatively large volume of short and long trades to capitalize on intraday market price action. These are our 5 differences between a day trader and an investor. 1. Time frames. Investors should be able and are willing to buy and hold an investment for the long run. It may be for years or even decades. The point here is that investors have to be patient and willing to let compound interest do its thing and avoid unnecessary interruption for the asset to appreciate in value or to grow and give consistent cash flow. On the other hand, a day trader, the person who either go in and out of trade consistently, they are more interested in making a quick bulk from the market of any asset classes. Let's give an instance. John and Drake were friends. John was the guy who at the end of the month keeps a part of his income in his investment account and keep on investing regularly for years and years. Years turn to decade, and on the other hand, Drake is actively on the computer, studying charts and candlesticks day in and day out. Days turn to weeks, weeks turns to months. In the illustration above shows clearly that John is the investor and Drake is a trader. 2. Stock type or share value. Day traders have different criteria than investors when looking for stocks. Day traders are more focused on technical analysis than fundamental analysis. Traders are not too concerned with a company's long-term potential, management team, etc. Instead, they are focused solely on price action, or say buy low and sell high. Day traders look for stocks with momentum and volatility. This creates the opportunity to take advantage of significant price action. It also provides the liquidity necessary to get in and out of positions. Investors, on the other hand, look for good companies with a good potential for future growth in the long term and with bargain price or intrinsic value or a margin of safety. 3. Risk exposure, risk experience. Some of the most volatile holdings periods involve earnings reports. Long-term investors take on the greatest risk during the earnings season. Public companies are required to provide a quarterly earnings report detailing the state of business and the prior quarter's performance. Most companies will also provide performance projections moving forward, also known as earnings guidance. Stocks can react violently to the corporate earnings report and guidance. Years of profits can be lost in a single session for missing consensus analyst estimates and guidance figures. Investors typically will decide whether to continue holding a position based on these results, where fundamental analysis plays a key part in the decision-making process. The day trader's risk is temporary and occur on a regular basis. The risk of a day trader is not tied to time. It can be terrible if the trader applied leverage and lost everything. 4. Commissions for the broker. Day trading involves more transactions, thereby generating more commission costs, whereas investing involves very few trades. A day trader may get in and out of a position multiple times in a single day, whereas investors may hold positions for months or years. Because of this, day traders are more sensitive to the broker's commissions. To an investor who plans to hold a position for years, a commission is insignificant. Contrarily, day traders are getting in and out of positions regularly, so commissions can add up fast. 5. Technical analysis versus fundamental analysis. Traders are more concerned with the technical analysis than fundamental analysis, because they are not interested in the long-term performance of a company, because the long-term profit of the company was to the trader no good, because they are more concerned with the short momentum and volatility of the market price, to make a quick bulk. But the investor, on the other hand, is concerned with the future growth they are investing. So investors relies more on fundamental analysis than technical analysis to know whether the company stock they are putting their hard-earned money in is profitable and will give them commensurate reward for their investment. Thank you very much for watching. Please don't forget to like and subscribe to this channel, and also comment on what stood out for you and what you did not like in this video.